We have seen extreme swings in markets during election years. In 2004, when Vajpayee-led NDA lost elections, markets fell 20% within 2 days. In 2009, when Congress-led UPA was re-elected, markets gained almost 18% within a day. Now, general elections are considered an important event for the stock markets. After all, the government that comes to power decides the economic policies. And these policies and reforms directly and indirectly impact the earnings of the companies and in turn stock prices. So we decided to analyze how the country's general elections have impacted the stock markets in the past. In this video, we will look at two things. One, how elections impact markets in the short and medium term. And two, which sectors tend to do well in the election year. There are some very surprising trends that we came across. So do watch the video till the end. But before we begin, a quick reminder. You're watching this video on ET Money's English YouTube channel. We also have a Hindi channel जहाँ पे आप सारी videos हिंदी में देख सकते हैं. And if you are or know someone who is interested in understanding the basics of finance, then we have a channel called 5-Minute Finance. The link is in the description. Okay, let's first examine how markets behave during elections. To analyze the relationship between markets and elections, we looked at the Nifty 50 performance before and after the election results. For example, let's look at the Nifty 50 returns before and after the results of the 2019 election. In the 10 days preceding the result announcements, the markets rallied about 5%. And 10 days after the results, Nifty 50 was up 4%. The trend was the same for the 2014 and 2009 elections. We saw positive short-term returns before and after the elections. In these three elections, there were no surprises. The election results were on the expected lines. So if there is a trend during the past three elections, should you make investments based on the post-election rally? And what happens if the results are not as per the general expectations? Are markets going to be adversely impacted? First, let's talk about the surprise outcome of the elections. In 2004, most people believed that the NDA would come back to power, but it lost the elections. And we saw a correction in the short term into the run-up to elections and after that. But let's look deeper into the data and check what happened to the markets 3 to 6 months after the election results. As I mentioned in the beginning, markets fell 20% within 2 days of the result announcement. However, what's interesting is within 6 months, the market stabilized and generated a positive return of 9%. So the negative sentiments prevailing soon after the elections changed in the following 6 months. Now the market's mood didn't change because the new government announced some big bang reforms. The correction that followed the election results made equities attractive. To understand this better, let's add the P ratio data of the Nifty 50 next to the returns before and after elections. Now the P ratio shows that markets were expensive before the elections. The correction that happened around the election results made the Nifty 50 undervalued. And so investors started buying equities, leading to positive returns 6 months later. Now 3 months before the election results, the Nifty 50P was 21. The valuations were expensive as the historical median PE of the index was 16.6. Now the day the results were announced, the PE was around 16, which made markets fairly valued. But the PE ratio fell as markets corrected post-elections. So 2 months after the election results, the PE was close to 13. This was quite a discount to the long-term median PE, making valuations attractive. Sentiments change. In fact, just 6 months after the elections, markets were in line with their long-term valuations. So, when the results are not as expected, there was a short-term volatility. But soon, the sentiments aligned with the fundamentals. Now, let's answer the other question. If the results are on the expected line, do we necessarily see a positive momentum? Now, analyzing the past two elections can answer this result. In 2019, the Modi government came back with a thumping majority. There was no surprises and the results were in line with expectations. But we didn't see markets clock double-digit returns in the short term soon after the elections. That could be because the election outcome was on the expected lines and the positive sentiments were already factored in when the market generated an 8% return 3 months preceding the results. Let's look at the P data to see if this is true. 6 months before and after the elections, the Nifty 50P was in a close range. It varied from 27 to 30. However, the 5 and 10-year median PE as of May 2019 stood at 23.27 and 21.59 respectively. Now, After looking at the median PE, the valuation surrounding the election period definitely appears to be overheated. So, without an explosive growth in earnings, it was unlikely for the market to see a massive rally. If markets would have gone up quickly, it would have resulted in frothy valuations. So 6 months after the elections, the markets grew by a meager 2.21%. In fact, after the results, the Nifty 50 PE began cooling down and it went from 29.02 to 27.31. In this second example, we saw again that fundamentals matter more than the election outcome. Finally, let's look at the 2014 elections. While the results were on the expected lines, we saw positive momentum in the market after the elections. The 3 and 6 month returns after the elections were around 8% and 16% respectively. We also saw about 19% returns 3 and 6 months before the elections. Now this looks like an ideal case for pre and post election rally. But let's once again look at what valuations have to tell us. The historical median PE on 16 May 2014 was 18.96 for a 5-year period and 18.58 for a 10-year period. On the day of election results, markets were trading slightly above their historical PE. So the index moved from being slightly undervalued to being a little overvalued after the results were announced. 6 months later, the markets were about 7% above their average median PE. It was around 21.33. This was slightly expensive, although the valuations were still not frothy. Now all these three examples show us that events like elections really don't matter in the medium and long term, but in the short term there can be massive swings. Now we move to the next part of our analysis. Let's see which sectors have done well in the last 4 election years. But before we proceed, we have been watching this video until now, then I'm sure you are finding it insightful. We spend a lot of time researching and creating content that you can use to make better investing decisions. So I would recommend you subscribe to our channel and press the bell icon so you don't miss any video from us. To find out which sectors delivered the highest returns during the election periods, we looked at the top 5 sectors in each election year. We looked at the data for 2009, 2014 and 2019. Now during 2004, there were only a handful of indices tracking different sectors. In the past 3 elections, the financial services sector was a top performer. Apart from this, there was no other sector that did well in all 3 election years. So next, we looked at the top performing sectors in any 2 election periods. The Nifty Banking Index did well in 2014 and 2019. The Auto Index was among the top performers in 2009 and 2014. Next, let's see how these 3 sectors performed in the last year and this year so far. In 2023, the financial services sector underperformed the Nifty 50 Index, and this year too, it has been underperforming so far. The same is the case for banks. When we say banks, we would like to focus more on private banks because they have been underperforming lately. So, if you would like to invest in stocks that have not moved up significantly and may be available at decent valuations, you can keep an eye on these 2 sectors. On the contrary, if you like to invest in stocks that are currently in momentum, you can look at auto and PSU banks. Now Nifty Auto generated 47% returns in 2023 and this year too it has generated a return of 16.21%. Similarly, PSU banks have been generating good returns. However, examine the fundamentals of these sectors before making any investment decision. Recently, we did an in-depth analysis of PSU stocks and why they are rising. If you haven't watched that video, then I would recommend you watch it. I've attached the link to that video in the description box below. Finally, let's look at some key things that you must keep in mind when it comes to your investment strategy during elections. In the previous section, we already saw that in the short term, market sentiments can drive the markets away from the fundamentals. But in the long run, it reverts back to its fundamentals. So this year too, you can use valuations as a compass to decide your investment move and use this volatility to your advantage. For example, as of 22nd April 2024, the PE ratio of Nifty 50 is 22.82. Its 5 and 10-year median PE stands at 23.62 and 23.53 respectively. So currently, the Nifty 50 doesn't appear to be overvalued or undervalued. If the positive market sentiments drive up the valuations, you can consider rebalancing your portfolio, which will help you book profits. On the other hand, if the market's correct and the valuations are attractive, you can consider investing more in equities. Now the companies have already started releasing their Q4 results. You can also keep a close eye on the earnings as they'll decide the course of the markets more than elections. Apart from the valuations, there is another metric that gains importance with the election results around the corner, and it's volatility. And to see volatility, we refer to the India VIX historical data. Now, if you don't know what India VIX is, let me give you a quick introduction. India VIX is an index just like Nifty 50. It is constructed to measure the volatility of the Indian market. So it shows the expected market volatility over the next 30 calendar days. The higher the India VIX index, the higher the expected volatility and vice versa. Now the index was formed in July 2010. You can see a graph on your screen since then. And as you can see, there are periods when the graph spikes. These peaks depict increased volatility. For example, around COVID-19, the India VIX went beyond 75. The markets experienced the highest volatility ever around that time. Now, historically, the index has averaged around 18.04. As of 19th April, it stood close to 13.4. Now, whenever there are events that can affect the economy and the business, then the volatility tends to rise. In the past, we have seen increased volatility during the election results. For example, on 15 May 2014, the Indian VIX stood at 36.76, while on 22nd May 2019, it was 27.63. Now, markets usually remain volatile around election results. Going by the past trend, the same could happen this time. So be prepared and don't be surprised if you see some big swings as we approach the election result announcement. However, don't let the swings tempt you in making any rash decisions. If you are a long-term investor, you have a system to buy and sell stocks. Stick to it and focus on the market fundamentals. Now, before I end this video, I would like to share some data around SIPs for mutual fund investors. Now, if you have an ongoing SIP or planning to invest in a new fund, don't be concerned about the market. We looked at the data to see how SIPs have performed historically during election periods. For this, we compared two data points. First, we looked at a 10-year SIP that was started 2 years before the election year. Second, we looked at the returns of the SIP that was started in the election month. For all such SIPs, the returns were between 11 and 16%. So if you already have an SIP running or are planning to start one, don't be afraid of the impact elections may have on your investments. If you have a long-term horizon, then events like elections don't matter. And with this, we have come to the end of this video. We hope you liked the video and found the answers to most of your questions. If you did, then don't forget to like the video and drop in the comment box what would you like us to cover next. I'll see you next time. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.